Hello, fellow Rebel Capitals. Hope you're well. So, I wanted to go into why I think the United States debt is going straight to $100 trillion dollars, and why I think it'll probably happen a lot sooner than most people think. Let's start by going over a chart. I'm going to do a screen share. Josh is MIA, probably on Tinder, as always. Or I think he might have switched to Bumble. I don't know. But we'll start by looking at a chart. Actually, make sure my mic's good. Okay. Of the US debt itself. So you guys are not that one, this one. So you see that the United States debt going back to, let's say, 1980 was a quaint 800, maybe 900 billion. And that has gone straight up to 37 trillion. Yay! Or I don't know how it gets 36.2, but it's basically $37 trillion. So if you look at this, you say, wow, George, 100 trillion. I mean, this would have to triple. We'd have to 3x from where we are right now in order for it to get to this $100 trillion kind of mind-boggling number. And I mean, how is the debt going to get there? The only way this could possibly happen is if not only we have massive deficits, but the Fed would have to come in and buy the debt. They would have to do yield curve control. Because if the United States government issues another, call it $60 trillion in debt over the next 5 years or the next 10 years, then obviously there's not going to be that many buyers. The bond vigilantes are going to come in. They're going to see the deluge of supply. The market's going to wake up to what we've all known for the last 40 years. They're going to dump treasuries. The long end of the curve is going to blow out as far as interest rates. And the Fed is going to have to step in, buy the long end of the curve, monetize the debt, and the release valve is going to be the dollar. Does this argument sound familiar? I think it does. I think it does. So now that we see, okay, the debt is at 37 trillion. And when you look at this chart, it looks like it's going exponential. But this chart's a little deceiving. It's a little deceiving. So let's go into another chart that shows the exact same debt, but in a different way, in a log chart. So it shows you the percentage increase. And this, I would argue, when you look at it in percentage terms, it's not necessarily going exponential. In fact, when you look at what the debt has done since 2010, it's a lot as far as this trend line. The trend line is a lot lower than we've seen in the past, such as, let's look at 2010 to 2020 and compare that to what we had from 1980 to 1990. So in percentage terms, the debt went up by a much, much, much higher rate from 1980 and even from 1970 to 1980 and from 1980 to 1990. So I think it all depends on how you're defining or what chart you're using for exponential. But if you're just using a normal chart instead of just looking at the percentages through a log chart, then yeah, it's definitely going exponential. But the main reason I brought this chart up is because when I say $100 trillion, I think a lot of people, even in the sound money space, are like, whoa, George, let's not go crazy here. Yeah, nothing stops this train, but not to that extent. And again, who's going to buy all this debt? And where's the money going to come from? This is a great question. But before we get into answering the question, I just want to look at what it's done in the past. So from 1970 to 1980, I don't know why, for some reason, when I switch the chart up like this, it doesn't give me any of the absolute numbers. But no problem. We'll just go back to this chart. So 1970, we're right around, call it 370. Then we fast forward to 1980 or so, around 900. So, 3x. We started with this, we times it by 3, and we're roughly close. We're roughly close. So my point here is if we can have an increase in the debt to this magnitude in the 1970s, well, why can't we have that in the 2020s? I don't know. Why can't we have that for the next 5 years? And why can't we have more than that? I mean, let's look at the increase from 1980. So we'll start at 900. And then we went to 1990. So now we're at 3.3 trillion. So an even greater percentage increase than we had in the 1970s. So, and actually, no, that's probably going to be our biggest move. So we're taking 900, and to get to 3.3 trillion, we just do some quick math here. That's pretty much the exact same math we need to get to 100 trillion from where we are right now, 37. So, in fact, I don't even have to do the math. You guys get it. Now, I'm just ballpark figure here, but you understand the concept. If we can do it in the 1970s, if we can do it to a greater degree in the 1990s, as far as increase the debt to the percentage we would need now to get to 100 trillion, like why on earth can't we do that in maybe even less than 10 years? Why couldn't we do it in 7 years? Especially if these deficits continue to increase, right? So you understand my argument as to why I think it's very possible, and it might even be my base case, that we get to 100 trillion at least within the next 10 years and possibly in the next 7 years even. So then the question becomes, what on earth happens to interest rates? What happens to the dollar? What happens to the Fed's balance sheet? There's just, if we issue another 60 trillion in debt in supply of treasuries, how on earth is that going to be absorbed by the marketplace? And this is a fantastic question. But my starting point to try to get my head around this question is to realize the amount of money. And I'm not talking about the Federal Reserve money printing. I'm not talking about the Fed doing QE. I'm not talking about yield curve control. I'm not talking about the Treasury somehow, minting a $10 trillion coin. That's not what I'm talking about. I'm talking about the amount of money that is created by the banking system. What's the limit on that? I don't know of one. Let me show you what I mean. So this is a chart of global GDP to the degree to which they could measure it. And we go back to 1985. I wish I had this back to 1980, but again, the concept is the same. You get it. So right here, we're at $12 trillion, $12 trillion of global GDP. Okay. And we got to remember that the dollar was the reserve currency. So if we're an economy of $12 trillion, just say the dollar's one half of at least 70 or 80% of the transactions, and we've got a velocity of 1, then that means, just call it 80, what would that be, $8 or $9 trillion globally. Okay. And the reason I go over this is because that's going to be the amount of money out there that has the ability to absorb the treasuries, the US debt, if they so choose. So as an example, if you have a global economy with $12 trillion and the government issues $60 trillion in debt, that's a problem, right? And most people would say that dog don't hunt because there's not even that much money in the world. So how on earth are you going to be able to sell $60 trillion worth of treasuries when there's literally only $8 or $9 trillion that exist? And I think this is the big mental block and it's understandable. because it's very intuitive. But this is the big mental block people have in understanding, how on earth has our debt been sustainable to the degree to which it has so far over the last 75 years? And why is it that supply really hasn't mattered too much at the long end of the curve as far as yields? Why is it all about growth and inflation expectations? Like, why? I get that that's the way it's been, but mechanically, how does that work? Let's go back to this. So if we now, actually, before we do, so global GDP at 12 trillion. Okay, we got it. So going back to 1985, we had roughly 1.7 trillion in debt. 1.7 trillion in debt. Now, you guys know, because you're smart, you watch this channel, that we did not have a bond issue in the 1980s. We didn't have it in the 1990s, even though the debt was increasing massively, massively. People were warning about it, but we didn't have the bond market blow up. There was a bid there. It still followed growth and inflation expectations. Or another way to say that's nominal GDP, roughly, as far as the expectations for nominal GDP. Okay, so now let's go ahead and fast forward to, let's go ahead and go to 2007. You'll see the debt is $9 trillion. $9 trillion. Okay. But remember, back in 1985, the entire global economy was 12 trillion. So roughly speaking, there was maybe $9 trillion circulating. So how does this work? Like, how is this possible that we can go from we can go from, let's just say 1.7 with a $12 trillion economy, and we can go all the way up to 9 trillion. And this didn't impact the long end of the curve. It was still about growth and inflation expectations. How is that? Where did all of this additional money come from? Another way to say that is going back and looking at nominal GDP. And look at this. We go from 12 trillion, we fast forward to just before the GFC, $64 trillion. $64 trillion. And let's assume that the United States dollar is 1/2 of the same percentage of transactions. How? Where did all this money come from? Where did all these additional dollars come from that resulted or that allowed for the GDP to go up to 64 trillion and allowed for there to be that capacity to absorb the 9 trillion in treasuries? Now, a lot of people would say, oh, George, well, that's easy. The government just printed the money. And when they mean the government, of course, they mean the Fed. So what we have to do next is we have to go to the Fed's balance sheet. And more specifically, we have to look at the reserves in the system, because this is, when people say the Fed is printing money and whatnot, they're simply talking about them creating bank reserves. So if we go to the Fed's balance sheet, we see that the amount of reserves in 1980 was 44 billion. And let's do 1985 to keep it consistent. So 40 actually went down, 41 billion. 41 billion. So the global economy went from 12 trillion to 64 trillion dollars, which increased the capacity for treasuries to the degree to which the world was easily able to absorb $9 trillion of treasury supply. But look what happened to the Fed's balance sheet. Do you notice anything here? In fact, we'll fast forward. We were at 41 billion in 1985, And in 2007, we're at 42. Where did all this money come from? How are those numbers even possible? The punchline is the banks created the money. The banks created it, right? The banks created this money, and it wasn't just from lending. It was from buying assets like treasuries. So this is, I think, one of the roadblocks that prevent people from really understanding why in the past, forget the future, but why in the past supply hasn't really mattered. It hasn't impacted long-term interest rates. Why it's always been about growth and inflation expectation, and why there seems to be limitless capacity for treasuries. Now, I'm not saying it's going to be that way in the future. I'm just explaining what it's been in the past. And nobody can deny, I don't care how much of a Bitcoiner you are, gold bug, or whatever it is, you can't deny that because it's a statement of fact that up until this point, there has been unlimited capacity for treasuries. And that's why the yields have always fallen, or always followed to a certain degree, or been correlated to nominal GDP, just growth and inflation expectations. Right. So now let's go over to let me make sure I've still got the screen share up here. Yeah, okay. So now let's go over to the Bank of England. And I want to zoom in here for you guys. So this is their very famous paper from 2014. In fact, I want to give them credit where credit is due. Now that I know a little bit more about this stuff, I don't really agree with everything in here because they omit quite a bit of very important information about the plumbing. But I do want to give them credit from the standpoint, this is one of the first things that I saw that really got me thinking differently. It really kind of opened up my eyes, and I had like that epiphany moment. And one of the things that got me really kind of noodling over this stuff was right here. So it shows the central bank's balance sheet, the commercial bank balance sheet, and the consumer's balance sheet when banks actually lend. So the commercial banks are right here. They were just doing just like one of my whiteboards where you've got assets on the left, liabilities on the right. You've got reserves and currency. Okay. We've got deposits. And then what this bank is going to do is they're going to make a loan. So let's just say a mortgage to a consumer. So when they do this, how does their balance sheet change? So now that loan that they created, or that was created, is an asset on their balance sheet. And look at this. They've got new deposit liabilities. These deposits didn't exist before. They simply weren't there. The bank created these deposits. They created quote unquote money, and it's technically not base money, of course, but who cares? It does. Last time you went to Chipotle, did they make you pay with cash? The answer is no. You could use your debit card. Well, why is that? Why wouldn't they require you to pay with base money? Why would they let you pay with effectively dollar credit as opposed to actual real dollars? Why aren't they making you settle on the Fed's balance sheet? Because in the real world, in today's day and age, not nobody, but very few entities, especially outside the United States, actually settle transactions, interbank transactions even, on the Fed's balance sheet. Why? Because the banks can create their own dollar credit to settle. See? So going back to this, new money, quote unquote, currency, dollar credit, whatever you want to call it, M2 money supply, but these dollars trade and transact, they're fungible with base money. So these dollars circulate just like any other dollars. And these dollars can be used by the consumer to go out and buy a house, or to buy Bitcoin, or to buy treasuries, or whatever it is, right? So most people understand that this process works how this process works when the banks lend. But what very few people think through is how this process works when the banks buy an asset. So let's assume for a moment this consumer down here had a treasury that they went out and bought. Okay, great. And let's say this consumer banks with JP Morgan. And JP Morgan wants to buy a treasury. So this transaction works. The consumer wants to sell, consumer being a non-bank entity, and the JP Morgan, the banking entity, wants to buy. So does JP Morgan take money from over here and give it to that guy over there? No. They do the exact same thing. They just simply credit their account by the amount of the treasury they're buying. So whether the commercial bank is buying a treasury or whether they're buying or whether they're lending money, it's the exact same process. The balance sheet looks the exact same after the transaction. But instead of new loans being the offsetting asset, it's a treasury. It's an offsetting asset. So if we go back to this chart and we sit here and ask ourselves, how on earth could there be how could there be enough money? How could there be enough dollars in order to have the capacity for the supply of treasuries to go from 1.7 up to 9, and how the global economy can go from call it 12.5 to 64? The answer is quite easy, actually. The banks just create the money. The banks create the money. So if there's $9 trillion in issuance, then if the banks want to, they can buy that issuance with brand new money that didn't exist before. That's how there's an unlimited. Now, don't get me wrong. If Scott Bessent comes out tomorrow and dumps $9 trillion on the market, that's going to make a difference. But that's going to make a difference. But I'm saying if he dumps $9 trillion on the market over the next 2 years, and the market knows this is what's happening, that's not the banks are going to create the money. They're going to create the capacity to buy those treasuries. Now, the next question becomes, well, George, why on earth would they do that? That doesn't make any sense. I mean, as an example, let's look at a chart of the 10-year treasury yield. And let's look at this period right here. So if you were a bank, now let me preface, this is most people's view. Now I'm going to say most people's view, and then I'm going to tell you why it's not entirely correct. So most people's view would be, okay, if you're a bank and you're holding treasuries right here, let's say the 10-year treasury, and it's yielding 0.5%, so 50 basis points, and you've got this thing on your balance sheet to today where the yields are 4.5%, holy cow, wow, you have taken a hit. You have taken a massive hit because the value of that treasury has plummeted. And by the way, it's plummeted when George always talks about this limitless demand for treasuries. Well, if there's limitless demand for treasuries, Mr. Smart Guy, how on earth did the yields go from 50 basis points up to 450 to 4.5%? And therefore, whatever bank or entity is holding this on their balance sheet, they just got crushed. They just lost, I'm just going to throw it out there, I don't know what it is, 40, let's say 50% of the value of this, maybe that's a little high, 30 or 40% of the value of that 10-year treasury was lost. So if you're sitting here telling me, George, that they're just going to expand their balance sheet infinitely to buy more and more and more and more of these treasuries that they just got their ass handed to them with, then this is nonsense. You're spewing drivel. This is a fair point. What you have to do when you look at the incentive structure around a bank is you can't look at it like your own balance sheet and what you do with your portfolio. Because if you buy a treasury and you hold it like this, then yeah, like a normal 60-40 portfolio as an example. If that 40% of your portfolio is in 10-year treasuries, you just took a massive gut punch right here. And let's just assume for a moment you decide to hold that treasury for 10 years. So at least you get your principal back. Well, think about how much money you're losing to inflation, because you're only being paid 50 basis points. And and it's debatable, but let's just say that inflation right now is whatever, 5%. The bottom line is your interest rate in real terms is dramatically negative. So you are losing huge amounts of purchasing power by holding that treasury, even if you're not going to sell it and take a haircut on the price. This is most people's view, and it's completely, entirely understandable. But it's totally irrelevant because that's not the way banks work. And the reason I harp on banks is because they, at the end of the day, are obviously the main player in the global monetary system. And if you don't believe me, for heaven's sakes, just look at the Fed's balance sheet. You think that the Fed, now you want to say this stuff, George, look at the QE, look at blah, 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 blah. Right, more recently. But if the Fed's balance sheet didn't matter in this time frame right here, why does it matter now? Like, why is if the banking system's not settling here, then why are they settling when the reserves go up to 2.7 trillion? I don't know. I don't know that they would. Right? There has to be a reason why the banks weren't using the Fed back here. And the reason is because it's cumbersome, and costly. It creates friction. So why would they just all of a sudden be willing to absorb that friction just because there's now more bank reserves? You see? So let's get back to it here. So this bump up is, and rightfully so, everyone's seeing though you're just losing this huge amount of money. But they're looking at that through the lens, like we just said, of their own portfolio and how it would work for them. But when we think about this in terms of the banks, we have to realize that they're not taking their own money and buying treasuries. That's not what they're doing here. They're creating brand new money when they're buying treasuries. Brand new money. So all they have to worry about is the spread between the liability side of their balance sheet, those liabilities that they just created, those are the dollars, those are the liability of the Fed, or excuse me, liability of the bank. So if they're paying, let's say 1% on these brand new dollars they just created, and they're making 4% on a treasury, that's free money. That's free money. So this is basically like me saying to you, if I gave you $150 million over the next 2 years, just in equal payments monthly, would you take it? I think most of you would say yes. But what if I said the inflation rate in the United States was going to be 5%? Would you still take it? The answer is yes. Obviously, I would, George. And this is what the decision-making process is for the bank. It's not, do I take my own money and worry about getting a negative interest rate or negative real rate? It's not, do I take my own money and worrying about the price of the treasury going up or down? They don't care. They don't care because they're just pocketing a spread. That's it. Now you say, well, George, what if it's like a Silicon Valley bank? And these treasuries they buy, they go up and then they have to sell the treasuries because they have deposit flight. Okay, well, that's a risk. That's absolutely a risk. And this answers the question as to why the banks just don't buy everything. Because that's a question, whenever I talk about this stuff, that's a question I get all the time. They say, George, what you're saying can't be true. or else the banks would just buy everything. They would buy every piece of real estate. They would buy every stock. They'd buy every piece of gold. They'd buy all the Bitcoin. They'd buy, if they weren't limited by money, why wouldn't they do that? Because the thing you got to get your head around there is when the banks create money, they're creating a liability for themselves. See, if you had a money printer, let's say, in your basement, and you just, let's say you're counterfeit, you had some way to counterfeit $100 bills that were perfect, or let's even say that it was legal for you to do that. If you print money, then all you have is an asset. You don't have an offsetting liability. You just have the green pieces of paper in your hand. But see, when the bank creates money, they're creating money to buy an asset, or an asset in the form of a loan, or the asset in the form of a treasury, or whatever it is, but they're also creating an offsetting liability. So this is the truth serum. So what this does is this limits them to buying something where they're most likely going to get a positive return. Because there's still quite a bit of risk in here, where if you had a money printer, there would be, and you could just print whatever you wanted, there would be no risk for you whatsoever to buy Bitcoin, Ferraris, treasuries, whatever it was, right? There's no risk because you didn't create a liability by printing the money to begin with. The banks do. And so this is why they have to be very careful. So understanding that, if you owned a bank and you realize that you could basically create money. Now there's some risk stuff and there's some other constraints there, but conceptually, technically, you could just buy as many treasuries as you wanted, or you could create as many loans as you wanted, or you could buy as many Lambos as you wanted. Well, would you buy those Lambos? No, because you're going to hold them and they're going to decrease in value, and then you're going to have negative equity, and then you might go bust. So even though you can print the money to buy the Lambo, you wouldn't do it because it's too risky, because there's a high likelihood that that Lambo is going to depreciate. And then at some time in the future, you're going to have to sell it and you take the hit. Now, all of a sudden, again, negative equity, you're upside down. You could go bust. What's different about a treasury? What's different about a treasury is you can hold it to maturity and you're going to get 100% of your principal back. Now, you might lose money to inflation, but the banks don't care because they're just simply pocketing a spread, and their liabilities are denominated in the same, their liabilities are in the same denomination as their assets, meaning their liabilities are dollars and their assets are dollars, dollar denominated. So if the value of the dollar goes down, that doesn't really impact them at all. Now that, let's say $150 million spread that they're making, okay, they've got a little bit of purchasing power loss there, but who cares, right? At the end of the day, it's still 150 million bucks. So what would prompt them to not buy a treasury? If they can buy all these treasuries, which obviously they can, going back to this chart, going from 12 trillion to 64 trillion. If the banks can create that much money to absorb, what is a greater percentage increase in U.S. debt supply than we even have now. Remember, that goes back to the to this chart, or excuse me, that goes back to the log chart. So during this time frame, when the debt was growing at a much faster rate in terms of a percentage, how the banks were just literally creating the money to buy the treasuries. And the yields on the treasuries were really fluctuating due to growth and inflation expectations. Okay, we get it. So what would prompt the bank to say, you know what? I'm not going to buy treasuries. I'm not going to take the free 150 million. What would make the bank do that? Well, if they look out in the global economy and they say, wow, I want to make more money. I'm going to expand my balance sheet. But if I do it with treasuries, I'm only going to make 150 million. But if I do it by lending into the real economy, Now, all of a sudden, I'm going to make 300 million. I like the 300 million. Now, why wouldn't they do that all the time? Because the risk is too high. It's all about risk and reward. So if the risk is very, very low, then they're going to go out there and they're going to lend in the real economy. They're not going to take that balance sheet capacity to buy treasuries. But if the risk is extremely high, then what are they going to do? They're going to likely take that balance sheet capacity and buy treasuries instead because the risk is much, much lower, especially considering the fact that the majority of the deposits outside of the United States are time deposits. They're not demand deposits. So it's very easy for banks to match up the maturities, meaning that if they're lending money, or excuse me, they're buying a 1-year treasury, they can borrow, or the liability side of their balance sheet is also 1 year. So they don't risk the whole Silicon Valley bank thing, right? See, even if they have a deposit, you can't take that deposit out for 1 year. And by that time, I'm paid my principal on the treasury. So there's very little maturity risk for these banks, especially outside the United States, where all the money is created to begin with. So going back to this, the reason the banks would do this is because they see more opportunity out there because the risk in the real economy is decreasing. Therefore, they're going to lend to institutions that don't have the ability to pay them back as easy as the United States government. Okay? So in that environment, where the economy is booming, is growth and inflation going to be lower or higher than you would see in an economy where the banks were risk off and just buying treasuries? Probably a lot higher, wouldn't you? A lot higher. And therefore, what's going to happen to interest rates when you combine all these factors? They're going to go up. They're going to go up. And it's the opposite if the risk increases, the growth and inflation expectations, the interest rates are going to go down because banks are going to be incentivized to buy those treasuries more than they're going to be incentivized to lend out into the real economy. So what ends up happening, of course, there's a lot of fluctuations in here. So the Fed jacks interest rates, this happens, but the overriding factor is the monetary system. So if you're a bank, going back to this, and you think growth and inflation expectations for the next 3 or 4 years, let's say 4.5%. That's about what nominal GDP is in the United States as we speak. So you think a good target is 4.5%. So let's just assume for a moment that Scott Bessent comes out and dumps all these treasuries on the market. And as a result, or because of some narrative or tariffs or something like that, there's some inflation scare where the interest rate on the 10-year treasury goes up to 5% or 5.5%. But you, as the bank, peg growth and inflation at 4.5. What are you going to do? It's a no-brainer. Because even if you wanted to lend out into the real economy, now the risk reward skews toward the treasuries. It's 5.5. Look at how cheap these treasuries are relative to growth and inflation. I'm going to buy. And there's no balance sheet restrictions because they're the ones that are creating the money to buy. And therefore, that's likely over time, it doesn't happen immediately, but over 6 months or a year, it's going to adjust that interest rate back down to what long-term growth and inflation expectations are. And it's the opposite. The opposite is true as well. If they're pegging the growth and inflation expectations at 4.5%, and for whatever, let's say we have stable coins come out, they all buy treasuries immediately, and Scott Bessent, says, I'm not going to issue any treasuries. So they're hoarding all of these treasuries, and let's say the Fed's doing QE at the same time or something like that. And so we have the interest rates go from 4.5 all the way down to 3.5. Well, now what are the banks going to do? They're going to sell. They're going to sell because now the prices are too high and they don't correlate. They don't correspond to what they think growth and inflation expectations are. So now they're going to sell those treasuries and they're going to do something else with that balance sheet capacity, which is going to bring the interest rate on those treasuries right back to approximately 4.5% or whatever long-term expectations are for nominal GDP. This is probably the most misunderstood thing in macro. I would venture to say it is by far the most understood thing. So I don't care if you're a Keynesian, an Austrian, I don't care if you're on CNBC, I don't care if you're a hedge fund manager, I don't care if you're a quote unquote influencer, I don't care if you're on FinTwit, I don't care what it is. I don't know of anyone that sees the banking system and the monetary system that way and has really thought through why the debt has been sustainable for so long. When we didn't even have enough money, like there literally wasn't enough money that existed on Earth in 1985 to absorb the amount of treasuries that would be issued over the next couple decades. There literally was not that much money on Earth. So and the Fed didn't do anything. So your only other option is the banks. That's it. Like that's where this road leads. All roads lead to the banks in the process that I just explained. So the good news is, and by the way, this is at the premise of pretty much every single macro argument you hear. Almost every single, and again, it's Keynesians, it's Austrians, it's Ray Dalio, it's everybody. Like the debt's unsustainable, the debt's unsustainable, the debt's unsustainable, the debt's unsustainable. And they've been saying this for 75 years, but yet none of them can articulate why the debt has been sustainable. And maybe, just maybe, what I'm saying is correct. And it is the banks and it is their ability to create effectively limitless amount of money. And they're happy to do so because they don't care about what the interest rates do. They don't care about the inflation rate in the United States because they're simply pocketing a spread. Maybe, just maybe, this explains why interest rates have never been impacted over the long term by supply concerns or supply narratives, supply expectations. Maybe that explains it. And if it does, what does that mean about all the other narratives around macro, around the stock market, around Bitcoin, around gold, silver, the Treasury market, etc.? I'm not going to answer that question for you. It's just something that I'd like you to ponder and maybe think about, because I think understanding the monetary system, I think it's well worth your time. All right, guys, on that bombshell, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.